Hey, Archie, what's it take if I want to be a millionaire someday?
Well, Rob, if you're patient, I'll show you. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast. We're your hosts, Archie Hoxton and Rob Hoxton. And today we're going to talk about becoming the millionaire next door. How do you do it? We work with a lot of people who are that and who are on their way to becoming that. And so what have they done that has made them successful at kind of hitting that pinnacle and that big milestone? So we've come up with a list of, sort of the highest value, most important things to do, important mindsets to have, habits to have, and we're going to dive into that today.
Yeah, and maybe we should also talk about what they look like.
Yeah.
Right? So the amazing thing about your next door millionaire is that they don't look like millionaires.
Right.
No Rolls Royces, no big gold Rolexes. Most of them are hardworking people. Oftentimes they have a small business and they save and invest and live within their means. And so they are pretty low, sort of under the radar.
Yeah. Yeah. And you might not know. I mean, some of them, that the Dave Ramsey folks, they did a study on millionaires, which was very interesting. And, some of the top careers for your sort of regular millionaires were people like engineers, accountants, corporate managers, teachers was actually in that list. And so these are people that you see around in your community. They're ordinary folks. Another one that we see a lot of around here would be, people who work in the trades.
Right.
And they've
HVAC,
just
plumbing, electrical.
Yeah.
Farmers
too.
Farmers are the sneaky ones.
Yeah.
They really play down their wealth, but oftentimes they have substantial wealth. A lot of it is in land, but not always.
Right.
Some of the most savvy traders I've run into, farmers.
Yeah.
Commodities trading, of course, but yeah,
right.
Very savvy.
Yeah. So it's interesting. And the idea here is that this is something that's attainable. It takes having some principles and some kind of rules to follow. And so I'd say one of the first things to do if you want to start this journey and that's a goal that you have is to have an emergency fund. I think it's really tempting to want to skip that step and go right to investing. And there's going to be temptation to kind of go into the most sort of hot opportunity, whether it's cryptocurrency or some sort of individual stock. But
yeah. I mean, if you're going to take risk, if you're going to actually invest in assets that will grow, which requires that you take risk, that you take an equity position, an ownership position in some sort of an investment, whether it be, a common stock of a company that you've heard of or a small business or whatever, piece of real estate, there's risk associated with it. And with risk, when we talk about risk, we're talking about sudden movements in the price.
Right.
Long-term trends that are positive, but from time to time, negative movements in the price. What you can't do is be in a position where if you have an emergency, you have to sell that.
Right.
You got to have enough cash set aside for that emergency so that you have the flexibility to allow that investment to continue to grow and come out of any kind of doldrum that it may be going through.
Right. Because risk is a reality that we all face. Some risks you can buy insurance for. Others you need an emergency fund for. And so that's really, I would say that's step one. Get that squared away. There's a lot of different ideas on how to do it. We have a video where we address that. There's a lot of schools of thought on how much you should have saved, but that should be kind of step number one. I'd say maybe step number two is starting and looking at what tools you have available to you for saving. And so that might be a high yield savings account for your emergency fund. It might be your 401k at work or a similar retirement plan. Or maybe it's having, opening an IRA or a Roth IRA, or just an investment account, sort of a general vanilla investment account that you can, buy mutual funds or stocks or bonds or what have you, and evaluate what options you have and start there.
Yeah, be sure to get whatever free money's on the table, right?
Yeah.
Yeah. So, and that sort of the free lunches in terms of savings and investing are things like being tax smart in the way you do it. Make sure that if you have access to a retirement plan at work that has an employer match or a profit sharing contribution, do whatever you have to do to get that money. Do not let it go. That's yours. Make sure you get it. Usually you have to put some money in first in order to get the match.
Right.
But make sure you do it.
Yeah. I mean, that's part of your compensation package if they're offering profit sharing or a match. And so you wouldn't turn down a raise.
Right. A lot of them double your money.
Yeah.
And without any risk.
Right. Yeah. So yeah, like if you put in 4%, they'll put in 4% and bam, that's double the contribution. So do some digging and figure out what you have available to you. Another interesting tidbit that came out of that Dave Ramsey research was that 8 out of 10 of the 10,000 millionaires that they surveyed used their 401k, right? And so that was sort of a key part of how it was one part, but it was a key part of how they got to that milestone of being a millionaire. So there's some talk against 401ks out there, but I mean, at the end of the day, you're saving and investing and you're getting tax benefits.
And the other thing, and we can't overstate this, we all have to fight with human nature, right? Our own tendency to wander off the path.
Right.
For me, it's diet, right? If you can put your pathway to becoming the next door millionaire on autopilot, you're half the way there.
Yeah.
So the nice thing about a 401k is if you enroll in the plan, you put enough in to get that match from your employer, and maybe you actually put an escalator in there, a clause that says that I'm going to have an inflation rider that increases the amount that I save, then you don't even have to think about it.
Right.
You just let it go, and bam, before you know it, there's real money in that account.
Right. Right. And that's one way that you can almost, accidentally sort of fail your way into a retirement by you don't even really look at it. It's set. Now, the important thing though, is that when you start, you need to have an investment selection, right? Because some 401ks may have like a money market or something like a stable value. This is very personal. It depends on you and your investment preference. So we're not giving advice or guidance here, but it's important that you don't kind of just put it in there and then don't do anything with it, because it's
right.
401k doesn't mean it's going to have growth on its own.
So investors become millionaires.
Right.
Savers, not usually.
Right.
So putting your money in a guaranteed savings account, even if it's in your 401k, that's not investing.
Right.
Right. Investing requires that you actually take some risk and that you invest in something that will grow at a rate that's higher than the inflation rate.
Right.
And guaranteed cash doesn't do it over time.
Exactly. And so that's where, and this is true for IRAs, it's true for just brokerage accounts, it's true for many other kinds of retirement plans out there, SEP IRAs, simple IRAs. So it's important to have a good investment strategy and then to have patience. It's not going to happen overnight. The growth tends to be backloaded. So when you're getting close to retirement, that's where you start to see those returns.
You get that hockey stick. If you look at the chart, your values seem like they're just inching along, and then all of a sudden, when you get closer to retirement, that's where the compounding effect goes. And that account should go just like this.
Yeah. I mean, if you take a 10% return, which is a reasonable rate of return for an equity portfolio, stock portfolio, in a given year, if you have $10,000, that's $1,000 return in dollar form, 10%. Once you get to $1 million, that's $100,000. So once you're at that level,
In a year.
in a year,
In a year where there's a 10% return.
Yeah.
Some years are going to be negative. You're going to go backward.
Right.
Part of the plan.
That's all part of it. That's why you plan ahead, and you. That's where the patience and the discipline comes in.
Let's say I'm 30 years old. I'm not, but you are.
Yeah.
So let's say for a 30-year-old, and they're chunking away, say $500 a month, they get a conservative rate of return, not 10%, something a little more conservative than that. How long does it take for that money to compound and become $1 million portfolio?
It depends. It depends on the rate of return. If you're saving $500 a month, and say it's 8%, that comes to about 35 years. So right on target at 65. That's assuming that you never increase your savings, though. And so that actually brings up another point that is important to think about when it comes to this journey, which I say journey because it is and normally is a long journey. So if you never change your savings, it might take a pretty long time or a higher level of investment risk. But if you're growing your income each year,
right, you're going to pay raise most years,
right? And if you're managing your lifestyle, things get more expensive. That's a part of life, but there are some things that we can control. So if your raise is enough to exceed your lifestyle, if you're not making big lifestyle changes, I call that lifestyle creep, then your over time, your savings should increase.
Right.
Right. And then there's a compounding effect with that as well. And so you get there faster and faster and faster each year.
Let's talk about something other than just your investment account, like your 401k.
Yeah.
A lot of wealth in this country has historically been created through homeownership.
Absolutely.
Right. And I know there are a ton of people right now that are looking at home prices, they're looking at mortgage rates, and they're thinking, how do I justify buying my first home?
Right.
And I get it. Well, understand this. Interest rates will probably drop.
Right.
If you buy your first home now and interest rates drop substantially, you can always refi.
Right.
Right. So don't let that be too much of a deterrent. Be mindful of your cash flow, of course. But homeownership has been a major factor for people becoming millionaires, and it's one of the big components, right?
Yeah. Yeah. And one of the main reasons for that is that, generally speaking, most people, the vast majority of people, when they buy a home as their primary residence, they're taking out a mortgage, right? So they're borrowing some money and they're putting some money down. And what that does is that allows you to magnify the rate of return that you get in your home equity, right? If you have a home worth $500,000, you put down $100,000 and you borrow $400,000. If that home over time later becomes worth $600,000, you've just made 100% return on your initial investment of $100,000, right? So that's part of that.
That's the power of leverage. Now it does go the other way too. If real estate prices drop, which we know they do from time to time, then that leverage can also sort of magnify on the downside. But people don't get as freaked out about housing prices as they do the value of their 401k, because there's not like a ticker on the front of your house that says your house is now worth this, now your house is worth this, now your house is worth that, like it is on your investment account.
Every second of
now,
the day.
Now Zillow's kind of works that way. I get this maddening email like once a month from Zillow. I don't even know how they know who I am, but they send me an email and they say, "Hey, Rob, your house is worth less now than it was last month."
Yeah.
So.
Yeah. Well, and it's That's a good point, because I think a lot of people treat their investment accounts and they look at them and think about them kind of like they do the bank account. It's really more like your real estate, your home. It's property that's worth a certain amount to someone else who may be a prospective buyer. And with investment accounts, you know what that person would pay all the time. One of the investing legends, Ben Graham, used to call it Mr. Market. He comes by and tells you, hey, this is what, you've got to be careful to not let that distract you from the end goal.
Let's touch on the high points here. So we haven't talked about the importance of bad debt, the kind of debt that you need to stay out of if you want to be a millionaire.
Right.
You got to try to avoid consumer debt wherever possible.
Yep.
Don't focus on doing a ton of investing if you've got a ton of credit card debt.
Right.
Get that safety fund, emergency fund set up, pay that consumer debt down, and then do it. And then, plan for it. Have a financial plan. Be ready and know what needs to happen each year in order to move you in that direction. And then remember just a couple of rules. Put it on autopilot if you can.
Yeah.
Get the match. Make sure you don't leave any employer money on the table with your 401k. And remember, in everything with investing, it's time in, not timing.
Yeah.
Right? Time is your friend. Being in and out of the market is your enemy.
Yeah. Yeah. Patience. And remember, these things don't happen overnight. There's a lot of viral advice out there that's all about get rich quick. It doesn't work that way.
We work with a lot
takes
of millionaires from next door.
Yeah.
And not a single one of them got rich quick.
Yeah. Yeah.
Sorry.
And so
somebody had to say it.
Yeah. It's not something that happens overnight. So have patience, have a plan. And if you have any questions for us, please feel free to reach out, leave us a comment. We love to hear from you all. Remember to like, subscribe, and share with your family and friends.
If you're listening, lots of great content on YouTube, on the channel there. So make sure you check that out.
Yeah. And we'll hope to see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.